So if you're like me, you've done a lot of learning the last 7 to 10 days about stocks and what a short squeeze means and why a company that used to lowball every single off race to try and make it them is now the belle of the ball in every single financial conversation. And you know what, guys? I love it. I love every bit of piece of it because, well, it seems that for the first time in human history, as opposed to the big banking institutions and the large hedge funds, it seems that the people have the upper hand. And well, this resulted in, as of today, February 1st. Wow, time flies. As of today, Monday, February 1st, the total losses in which the big hedge funds have faced is now up to $19 billion. And right now, there are those people who would say that that's not enough. And you know what? I would also agree. Because of the careless and reckless acts of the big banks, it resulted in the American people losing $5.6 trillion, not billion, $5.6 trillion worth of life savings, liquidity, real estate value, 401k savings, pension funds, and so much more. And guess what? Those big banks and those hedge funds that caused all this got bailed out by the government. And you know where the government got that money from? From the very people that paid the government in the form of taxes. So let's lay this out. The people paid the taxes, and that money bailed out the very entities that screwed over the people who paid the taxes in the first place. So yes, I'm very happy with what's happening with GameStop stock and also the Reddit community Wallstreetbets, of which I'm a very proud member of. And of course, I'm mostly happy about the masses finally getting an interest and learning a lot about investments, stocks, and how they've pretty much been getting screwed for decades. But what this video is going to be about something much bigger. It's much bigger than GameStop. It's much bigger than Melvin Capital. It's bigger than any hedge fund, and it's even bigger than Wall Street itself. Because what if I told you that these Wall Street bankers and these hedge funds are just a mere byproduct of what the bigger problem is? It's kind of like the first Avengers movie when, the Avengers are fighting the Chitauri army, but at the end they realize that there's something much bigger, that there's actually a more powerful, more deeper villain lurking within, right? Which is Thanos. That's kind of like what's happening right now. And well, what is Thanos in this situation? Well, that, my friends, is the American financial system. So let's get right to it. Let me first start by saying that I believe the American financial system is best described as a casino. Well, why a casino? It's because, well, think about it. When you go to a casino, the odds are highly favored against you and very favored towards the casino and the house making more money. And yes, there are a lot of loopholes that are written to potentially help the American people. But, well, ironically and also very coincidentally, these same loopholes are not being taught in the school system, right? Taxes being a very main topic. And, well, that leads me to say that I'm very glad that when I was in the 4th or 5th grade, I learned what a rhombus was because, well, it's really going to help me this rhombus season, when I put together my paperwork. It's really going to help. Now, this casino is broken down in two halves. We have monetary and fiscal policy. Monetary policy is practiced through the big banks, and, well, fiscal policy is practiced through government. Now, let's first start with the average American's relationship with the banks, and let's break it down in its most simplest form, getting a 30-year traditional mortgage. So let's say there's a guy named John. Now, John is in his late 20s/early 30s. John is married to the love of his life, and him and his wife are looking to start a family soon. So therefore, he wants to buy a house. Now, let's say that John, he knew this day would come. So he had about $60,000 saved up for the down payment of this house because he really wants a house that's around $300,000. Now, guys, I used $300,000 for this example because, well, the median sales price for a house in the United States in 2020 was about $320,000. And, well, $300,000, depending on where you live, is either a really, really nice house or pretty much a dump. So let's go ahead and just use $300,000. So he saved up $60,000 because he knew this day was coming. So $60,000, that's enough for a 20% down payment. And let's say that John is fiscally responsible and has also an additional $30,000 in his savings account. Now, guys, that's very important. The fact that he has $30,000 in his saving account for a later reference. So keep that in mind. Okay, so let's continue to break this down. The terms of the loan are 20% down, 30-year amortization, which is your standard mortgage, and let's use a 4% interest. Now, guys, I know that's high, especially for where we are right now, but considering that we're seeing record lows in interest rates, let's use the interest average for the last 10 years, which is around 4%. Now, if we do the math looking at this screenshot here, this gives us a monthly payment of $1,145.80. The annual payment being $13,749.56. Now, John, being the average American, will look at that monthly payment and tell himself, Yeah, I can afford that as long as it doesn't exceed 1/3 of my monthly income. I should be okay, right? Well, like most Americans, 99% of them, right, if we're going to be more exact, don't see the last page of their mortgage document, which is what's known as a truth in lending statement, which was made possible by the Truth in Lending Act passed in 1968. Well, if John and other Americans were to read that truth in lending statement, he would see what's really going on. Now, this is where the banks really start making their money, and this is really how we kind of start uncovering how the banking system really works. And this is where we kind of cross the line of mainstream knowledge into something that not a lot of Americans know about when they should. Because if you see this chart here, guys, and by the way, this is a screenshot from Carl's Mortgage Calculator. It's a free app. I'm not sponsored by them. It's literally something I use every single day to analyze my real estate deals. But if you see this chart, you'll see that out of the $13,749.56 worth of payments you're making that first year, right, in John's example, $9,000, $9,523.07 is straight interest the bank is making off of you, and that's money that's going into their pocket. That's literally almost 70% of all the money you're putting in your first year in the form of a mortgage is going to the bank, meaning that for John, 70% of the money he's paying his first year in his mortgage is money that the bank is literally putting into their pocket. And in this example, John would actually have to wait 13 years before his payments start being more equity and principal as opposed to interest and money that the bank is putting into their pocket. And well, this is where the banks also get a little smarter because the banks know, guys, that within those 13 years, you're most likely going to either A, move to another house and get a new mortgage and go back to that 70% ratio, 70% of which is interest, pure profit for the bank, as opposed to actually helping towards you build a better future. They either A, know that you're going to move, or B, you're going to refinance and you're going to, for the sake of a lower payment, you're going to refinance your mortgage, which, by the way, resets that amortization clock back to 70% ratio before having to work yourselves up again to get to 50-50, or better yet, a position where the payment that you're making is more towards your future and your equity and your principal as opposed to straight interest that the bank is profiting. Well, some of you might ask at this point, well, Daniel, what if they don't do either one of those things? What if they don't move, or what if they don't refinance? Well, if that's the case, over the period of 30 years, without, again, moving or refinancing, you would have paid $172,486.82 in interest, which is, again, money that the banks are making off of you. And by the way, the vast majority of that $172,000 is made in the first 5 to 10 years of the loan, which means that the banks make a lot of that up front. Now, mind you, this is the best case scenario. If you don't refinance, if you don't move, if you pay off your mortgage in a straight line. Now, here's the craziest part, because now you might be asking yourself, well, Daniel, where do the banks get all this money to lend us? Well, do you guys remember that $30,000 that John had in the savings account? Well, this is where it comes into play. Because what the big banks will do, and what is deemed as normal monetary policy, is for the big banks to leverage the $30,000 that John has in the savings account and use it to get more money from the Federal Reserve to loan out to us. And that leverage is what's known as a reserve requirement. And that reserve requirement is usually represented in the form of a percentage. Now, most of the time, the reserve requirement is mostly set at 10%. That meaning that with the $30,000 that John has in the savings account, that the liquidity is in the bank can then actually borrow $300,000 from the Federal Reserve, which, by the way, right now, the lending rate between the Federal Reserve and the big banks are at 0%, meaning that there's no cost for them borrowing this money. So to pretty much summarize John's situation and pretty much bring this whole thing full circle, the banks used John's $30,000 to leverage it and borrow $300,000 from the Federal Reserve, which, by the way, right now is at 0%. And then they used the $300,000 that they get from the Federal Reserve to then loan to John so that he can buy his $300,000 house, all before, right, of course, they take $60,000 in the form of a down payment, increasing their liquidity even more, which means that now they're able to get $600,000 and loan it out to other people. And all in all, the money that they loan to John, they make their profits and their interest all the way up front while leaving John with all the risk. Because, well, what if that house drops in value, right? That $300,000 house. The loan stays the same. The balance of the loan stays the same. The interest stays the same. The money that the banks make all stay the same. But it's that any risk and any variable, John is responsible. Because meaning if the value of the house goes down, well, guess what? It's John's equity that gets relinquished first before the banks does. Now, that's the most common form of banking that we all know and love, but of course, banks issue out multiple programs that pretty much follow the same concept. Now, what's crazy is that we haven't even touched on investment banking, which there's a lot of programs and words that I'm sure is way too complicated for the average person to understand, but which of course, maybe that's the way it is because maybe they don't want us to understand. But of course, that's a video for another day. Hey everyone, Jordan Belfort here, telling you to subscribe to the Kwok Brothers and like this video. If you guys have 60 seconds, I'll tell you why exactly you should subscribe and like this video. Is because the Kwok Brothers are here to stay. They're not leaving. They're not leaving! Now, having said that, fiscal policy is really no different. Matter of fact, the textbook definition of fiscal policy is the use of government spending and tax policies to influence economic conditions, especially macroeconomic conditions, including aggregate demand for goods and services, employment, inflation, and economic growth. But now, guys, without getting necessarily too deep into it, I think we can all agree that the way that fiscal policy has been done, the way that governments usually spend their money, hasn't necessarily been in the best interest of, well, us, the taxpayer. Especially looking at who they tend to bail out and, well, where that money goes. It just seems that based on my own personal observation, it's not really in our best interest and it's not really helping us out. And the worst part of it is, the whole thing with monetary policy, fiscal policy, and the American financial system, well, it's most likely that the big banks, the big hedge funds with the government at their side will find some way to fight back against Wall Street bets, fight back with everything that's happening with GameStop and fight back against something that finally made things equal playing. And Robinhood and TD Ameritrade has already done it to an extent where they prohibited certain people on their platform from buying certain stocks and certain securities. But the reality is that most likely these big banks and hedge funds will find some way to crash the market or manipulate the market and take control back once again. Or another thing that can happen is that governments can push out laws, rules, and regulations that prohibit from the people actually banding together and making this an equal fight, or even worse, preventing something like this to happen ever again. Now, both might happen. I would not be surprised if it does. Now, guys, all these things may sound extremely depressing. And you know what? It is. It is depressing. I remember learning how the financial system in America really worked when I was 18 years old, when I first started learning how to invest and started learning about finances and economics. And it really answered the question and curiosity as to why, stuff like taxes, practical life skills, investing, starting a business, why none of these things were actually taught in the basic education system. And to be honest, guys, everything that we talked about in this video with monetary and fiscal policies, with big banks and hedge funds and the banking system is the primary reason why I actually started investing in real estate. Because I saw that with stocks and other investment vehicles, how easy it was for these big institutions and for the system to manipulate the market to favor them as opposed to the people. I saw how crooked the system really was 8 years ago. But on the other hand, I saw that with real estate, how much control I can have, how much freedom I can have in structuring a partnership to buy a cash flowing rental property with tax benefits, with growth, with cash flow, with depreciation. I saw a lot of great things on that hand of the spectrum. And considering that shelter is one of the top 3 things that humans need, I saw real estate investing as a very safe bet. Now, guys, having said that, I didn't have a whole lot starting out. Matter of fact, at 18, when I first started learning about investing, I had negative $187.65 in my bank account. I had horrible credit. And well, considering my dad was a preacher, I didn't have a whole lot of people that I could turn to learn how to invest in real estate or learn pretty much about anything in my network. So I had no network and I didn't know any people as well. Now, guys, this isn't like a rags to riches story, and that's not what I'm trying to go for here. But what I am saying is, as cliche as it sounds, I did learn how to work hard and also how to work smart. And I built a lot of great habits in my life the last 8 years, considering that I'm 26 now, to build a multi-million-dollar portfolio and other businesses that I do own today. So if you're interested in learning more about real estate, investing, and also the markets, as my friend Jordan Belfort says, subscribe to our YouTube channel and like this video so we can get this information out, especially how the banking system works and how the American financial system works, so we can get it out to as many people as we possibly can. I know if you guys like this video, it really helps us out with our algorithm. So again, I encourage you guys to subscribe and also like this video. And also, if you want to get even deeper into it, guys, my book, 0 to 75 Rental Units in 1 Year, is literally free. I made it free so that everybody can enjoy this information, so everybody can take control of their own finances and build their own legacy. All you guys got to do, guys, is pay for shipping. So go to 0 to 75 units PropStream.com. The link is also in the description. So again, guys, I hope you enjoyed this video, and I really do mean everything I say. I really hope everybody gets to learn more, and I'm so happy that people are starting to get into learning about stocks and investing and how all this really, really works because, well, we're the ones that really make the big changes. So again, if you enjoyed this video, guys, thank you so much. I'll see you guys in the next one.